I'm Toby Lynn, and I'm here to talk to you about mortgage insurance. Here's the first thing, is a lot of people will say to me, oh, that mortgage insurance is such a ripoff, the lender gets it, and the loan is really good. Well, that's not the way I look at it. I say it's an opportunity. It's an opportunity to buy. Because prior to mortgage insurance, which I think came about in the 40s, I'm not sure about that, but I think so, you couldn't even buy a house without 20%. So it's an opportunity to buy a home by putting down less than 20%. First, I'm going to talk about FHA. FHA has changed over the years what their rates are, how they collect it. Right now, the way it's collected is there's an upfront fee. It gets rolled into the loan amount. So let's say you have a minimum down payment of 3.5%. 1 3/4 of that is rolled back into the loan. That's called the upfront fee. And then you have a monthly amount. It does not matter what your credit score is. You get the monthly amount. And unless you put down 10%, there is no option to ever be able to get out of the FHA mortgage insurance. Now, there's plenty of reasons why people go FHA, and usually that might be because of a more recent derogatory credit event. So it could be more recent short sale, foreclosure, and bankruptcy will typically be the reasons. But there's others. It could be debt ratios. Anyway, that's one of the things we would talk about regarding choosing the right loan. Conventional loans. Well, conventional loans have a whole menu of how they charge mortgage insurance. So it's based on how much you put down. It's in 5% increments. So let's just say you're buying a home at whatever amount, and you're going to put that you had in mind to put down a flat dollar. Unless it's hitting a 5% increment, there's hardly any advantage for you to do that. The mortgage insurance is charged based on that. It's charged based on your credit score. So what I do is I've got my little cheat sheet right here. I look at it all the time. And what I do is I look at the credit score. I think credit score is up there. And what the loan to value is. And basically it comes together. Mortgage insurance conventional you can get out of. And it just depends. So there's lots of different ways to pay for the mortgage insurance also. The most common way is what we call monthly. The monthly, it's called non-refundable mortgage insurance. And that will give us a monthly amount the borrower pays, and when they're ready to get out of the mortgage insurance, when they can qualify based on a couple of different requirements, they can get out of it. There's another way to pay mortgage insurance that's called lender paid. In return for a higher interest rate, the lender literally pays the mortgage insurance, and the buyer just takes the higher interest rate with no monthly. At first glance, you might say, why the heck would I want to do that? But there could be reasons also. Let's say you're going to only be in the home for a short period of time. Well, that might be worth it. Pay a higher interest rate and get a lower payment. It might work out for you. It also depends on the credit score. So there's a whole grid about how these things come together. The seller, within seller contributions, could pay for that one-time upfront fee. That's possible also. There's also something called a split plan that I might look at splitting up a lower monthly for an adjusted upfront amount. The key to finding out which is the best way to go is call me. We can talk about it. And, the key is to have it be for you. What's the right circumstance for the buyer situation is always going to be the top priority when we're working together. Call me, 404-786-5953, or you can find me at theperfectmortgagesolution.com. Hope you're having a great day. Bye.